China's new home sales just plunged 41.9% year over year in October, and that's not a blip. It's a rupture in what many consider the world's biggest store of wealth, real estate. China is the single most valuable property market on Earth, and when that engine stalls, the ripples hit banks, commodities, jobs, and your portfolio, even if you've never set foot in Shanghai. If the largest piece of the world's largest asset class wobbles, credit markets tighten, earnings compress, and a safe yields fall. China's 10-year government bond has been hovering around the 1.6 to 1.8% range this year, levels that scream deflation fear, not boom. Today, I'll break down what broke, why rates are sliding again, and the three signals that tell you how far this goes. First, what actually happened. Fresh data shows the value of new home sales among China's top developers collapsing in October, snapping last month's brief stabilization. Prices had already been sliding, with new home prices posting their fastest monthly drop in almost a year. Buyers are stepping back, developers are under extraordinary balance sheet stress, and local government finance, much of it tethered to land sales, is feeling the strain. Remember the scale here. Global real estate is roughly a $393 trillion asset class, bigger than global stocks and bonds combined, and China is a massive slice of that pie. When China's property demand cracks, it's not a China story, it's the macro story. Why is this different from every other scary headline you've seen over the past few years? Because it's not just about house prices, it's about the macro plumbing underneath them. China's GDP deflator has been negative for most of the past 10 quarters. That's economy-wide price pressure, revenues down, margins squeezed, and debt getting heavier in real terms. You can't deflate your way to a healthy recovery. Households feel it directly. Somewhere between 2/3 and 70% of Chinese household wealth is tied to property. When confidence breaks, people close their wallets. That's bad for retail, jobs, tax revenues, and the feedback loop you need for a durable rebound. Bond markets have been voting with their feet. China's 10-year yield spent long stretches under 2%. When a market that deep and liquid sinks that low for that long, it's the collective judgment of millions of price quotes saying, no growth, no inflation. That's not just a China signal, it's a global one. Because rates markets tend to move in synchronized waves. If you're wondering why, after all the headlines about raging inflation a couple of years ago, long-dated yields keep getting dragged lower again, look east. The world's biggest property engine is sputtering. Now let's translate a bit of economics into plain English. The Beveridge curve. It's a simple plot of job vacancies versus unemployment. When demand softens enough, companies stop posting jobs and eventually start trimming headcount. China has been trying to avoid that outcome by keeping factories running even when demand wasn't there, absorbing the pain through lower prices instead of higher unemployment. But you can only fight gravity for so long. As the property bust drags on and stimulus fails to lift real demand, Beijing faces a brutal trade-off. Keep producing into weak demand and crush prices further, or allow the labor market to adjust and accept more unemployment risk. Neither path is painless. What about policy? Beijing has tried a bit of everything: rate tweaks, easier mortgages, rescue funds for developers, and local easing. Each announcement brought a few weeks of optimism and a couple of green shoots, but no trend change. There's too much inventory, too much scar tissue on developer balance sheets, and too much household caution. Meanwhile, banks are behaving exactly like banks do when growth looks shaky and policy transmission is weak. They prefer holding government bonds to extending fresh credit into sectors that feel like quicksand. It's classic safety and liquidity behavior, and it means the places that need credit the most often get it the least. This does not stay in China. It spills outward in three big ways. First, rates. Global bond markets are joined at the hip. When a giant economy's long-term yields slide because growth looks scarce, it nudges term premiums down elsewhere. Second, earnings and commodities. A weak Chinese housing cycle is a problem for steel, copper, cement, appliances, and the entire web of suppliers that plug into construction. You'll feel it in global PMIs, corporate guidance, and margin commentary. Third, currencies and neighbors. Pressure shows up in Asia's exporters and FX as China's demand pulse softens. If you watch Korea and Japan, you've already seen the tremors. So what actually tells us whether this is a bruise or a break? Three red alert signals. Number one, primary market sales and pre-sales. Do monthly sales keep contracting versus last year? A few consecutive prints worse than minus 20% would flash systemic stress because pre-sales fund construction. If pre-sales vanish, completion risk rises and confidence falls further. Number two, the quality of the policy pivot. More supply-side tinkering won't cut it. If you start seeing fiscal measures that shore up household balance sheets, direct income support, programs to complete stalled homes, and targeted fixes to household confidence, that's a different animal than just cheaper mortgages for a product people don't want. Number three, Yields and the curve. If China's 10-year slides toward the mid ones and the curve stays flat, markets are screaming that stimulus isn't curing demand. A durable upshift in yields with some steepening would be an early sign that growth expectations are turning. What does all of this mean for you right now? If you're an investor, expect episodic risk-off moves, lower term premiums, and pressure on cyclicals tied to construction and heavy industry. Your factor exposure matters here. Quality balance sheets and stable cash flows tend to outperform when growth is scarce. If you're a homeowner or borrower, a weak China plus soft global growth often pulls long rates down. Good for refinancing windows, but it's a bad news. Good rates set up. Know what you'll do if your rate target shows up. Don't wait until it's gone. If you're a macro watcher, be skeptical of all clear narratives built on short-run upticks. In this kind of environment, markets often front-run the data. Yields move first, headlines rationalize later. Let's also talk about the emotional reality behind the numbers, because that's what determines behavior. For a decade, households in China were taught that property was the safest, smartest way to build a future. When that belief cracks, it doesn't quietly fade. It snaps. People who feel poorer spend less, delay big purchases, and cling to cash. Developers who feel squeezed don't take risk. They cancel projects and dump assets. Banks seeing that behavior hide in government paper. Policymakers, seeing everyone de-risk simultaneously, try to outshout fear with bigger headlines and bigger numbers. But confidence doesn't answer to press releases. It answers to completions, paychecks, and price stability. Until households believe those three things are real and durable, they will not come back. If you're thinking, okay, but could this all flip on a dime? Here's what that would look like. You'd see consistent, month-after-month stabilization in new home sales, not one-offs. You'd see completion rates surge, not just construction starts. You'd hear developers talk about cash flow normalization instead of liability management. And you'd see yields drift up for the right reasons. Because growth and inflation expectations are finally crawling out of the basement, not because of a supply scare. That's the checklist. If those boxes start ticking, we'll say so loudly. This isn't fear-mongering. It's a reminder that when the world's biggest real estate market catches a cold, the global economy shivers. The data right now says demand is cautious, policy is trapped between bad options, and markets are bracing for lower growth. But none of that means you're powerless. You can prepare. You can decide what you'll do if mortgage rates hit your target, how you'll position if cyclicals roll over, and what you'll buy if quality goes on sale. If you want a deeper dive into how bond markets front-run recessions and the 3 charts I use to track it, hit subscribe and check the video linked on screen. And I want to hear from you. What was the most surprising stat you learned today? Drop it in the comments. It really helps the algorithm, and it helps us all learn faster together.